This is, it's very needed. So
Mm.
we'll go ahead and get started. Good afternoon, everybody. Welcome to another TMC Connect partner webinar. I'm Melanie Thomas, and today I'm here with our preferred partner, Zactus. I am joined by Jack Burles and Jane House, and they are going to be discussing trigger leads. It's going to be some gripping stuff that we're excited to have you listen in and join. I just want to do some quick housekeeping before I hand it over that this webinar is being recorded. All of the attendees are muted, but if you have questions, definitely drop them into the chat and we'll get them answered. Everybody is going to be getting a recording of this and also a copy of the slide deck after the presentation. So with that, I'm going to hand it over to Jack and Jane.
Thank you, Melanie. Yes. Well, Zach just really appreciates being a partner with TMC. We've gotten a lot out of our relationship over the years, and we really appreciate the opportunity to talk about HR 2808. It's been a topic that's been burning up the airwaves, especially for Jack and I, over the last few months. Um, Jack, are you able to share our deck with the team?
Absolutely. Will do. Let me go ahead and share a
There we go.
screen. Give me a minute there. You guys should be able to see my screen right
Yeah.
there.
There we go. All right.
You're
Well,
all set.
Jack and I represent the Data Solutions Group here at Zactus. And essentially, what our focus is on things that help our clients acquire new loans, help them manage risk in their portfolio, anything like that. And monitoring programs are a key part of that. And monitoring programs have changed tremendously with HR 2808. So what we're going to be focusing on today is kind of, an overview of how HR 28 came to be, what was allowed before, what's allowed now, really understanding what's happened with those changes to monitoring programs. We'll talk a bit about what we're seeing in the industry because this has truly been a game changer for our industry in terms of how that information can be used going forward. Jack, I'll let you introduce yourself as well, and then we can kick things off.
Perfect. Thank you, Jane. Jack Burles here. Rounding the bend with Zactus now for 5 years, but I've been in the industry for almost 25 years, working really closely with all of our clients on credit data. We specialize in all things credit, portfolio monitoring, pre-screen, account review, all solid solutions for end users. And we are super excited to be here today. As Jane mentioned, HR 2808 is really kind of changing the game. A lot of new awareness around mortgage inquiries, what they are, how they work. So we're going to try to, move through a couple of slides here and kind of dispel some of the myths and try to make clear the allowable use cases. And as Jane mentioned, if you have any questions, drop them in the chat box and we'll do our very best to answer them. And thanks for having us today.
There we go. Thanks, Jack. Well, yeah, HR 2808, what we ended up with there was that it had really came about based on a lot of the abuse that had been going on in the industry. For years and years, prospect triggers were allowed, and that meant anyone that was put in a new mortgage application that was going to hit the bureaus, and those were being resold as prospect triggers. So consequently, if you applied for a mortgage loan, suddenly your phone was blowing up with tons of phone calls from every lender out there that was purchasing a prospect trigger lead. What HR 2808 has done is as of March 4th, only retention triggers can be sold. And what I mean by retention triggers, you see there are four allowable use cases that were put in place with HR 2808. Consumer consent. If you were the current servicer of that loan, you can still monitor that and still receive monitoring triggers on new loan applications. If you originated that current loan, again, you can still receive triggers on those. Or if you were a third-party insured depository. And what we're talking about there is like a bank or a credit union. If you had an existing account, such as even a deposit account, those consumers can be monitored by that institution and they can reach out to them anytime there's a new application for credit by that consumer. I have to say, compliance is the name of the game when it comes to any sort of monitoring program. So once HR 2808 came into play, anyone who wanted to buy these types of retention triggers are having to put in a bureau application which notes what their use case was. In fact, on consumer consent, that's been a real gray area. We're seeing that that isn't had wasn't really very well defined within the legislation. So much so that one of the bureaus, Equifax, has said they won't utilize consumer consent as a use case to receive mortgage triggers. It has to be either the current servicer, current originator, or that third-party institution track that we're talking about here. So consumer consent, what is that going to mean? Sometimes there's maybe some small print on a loan application saying you're going to allow us to continue to contact you. There hasn't been a test case of this yet, so we really don't know where that's going to go. We'll have to dig into that deeper. Zactus monitors the bureaus constantly, looking for any new information on this. There's been additional compliance regulations that have come through from the bureaus once this went into play. We've seen some bureaus will revise their consent forms, things like that, to get this, in play with their applications. So we'll keep our ear to the ground on this and keep everyone apprised as we get new information. But for now, we need to focus on these three areas for who can use the new triggers. I saw there was a question in the chat. Let me see if I can pull that up again.
Yeah, and while you're doing that,
Yeah.
Jane, I just wanted
Yes.
to expand on one thing about consumer consent because we have today, many of you know that we have um, opt-out information, right? The bureaus have provided clear direction on consumers that wish to opt out of future offers, right? So you can dial 1-888-5 opt-out. You can go to the various bureaus and opt out of credit offers. But consumer consent feels like an opt-in. And I think that's kind of where some of the gray area is on consumer consent. What does that even mean? So I think in the early stages, what we're seeing is our clients are focusing, and clients that have allowable use case are really focusing on, to Jane's point, are you a current servicer? Did you originate the loan? Are you a third party insurance, depository institution like a bank? Um, and I think those are very clear. But even within the originator piece, right? If you've funded a loan for a consumer 12 years ago, does that mean you still have a relationship today? And can you reach out to that person today? Maybe, maybe not. We have best practices on our side of the house for monitoring and retention strategies that are as simple as, do you actually have a current phone number that you can reach out to that consumer? Do you have an email that you can send them an email? Do you have a mailable address where you can send them a piece of direct mail? So it comes back down to sort of the current status of that relationship that you've had with that consumer that you've previously funded a loan for. But again, the gray area is there too. So everybody's trying to sort of navigate. So, all kinds
Exactly.
of good questions here.
Yeah, and I see the question from Kevin. He was asking, what's the statutory definition of a consumer account for that third-party category? Is this purely depository accounts, or does it apply to credit cards, student loans, etc.? Well, yes, it does. Any sort of relationship that third party has can be monitored for new mortgage applications. So what does that mean? I have a credit card with Chase. Well, Chase has a mortgage department, so they might want to start monitoring my credit to see when I've put in a loan application elsewhere. Even though I don't have a mortgage with Chase, I've got a credit card with them, so they would be able to monitor me. And as Jack was saying, as we define these different categories, that current originator, that also can mean that you're looking at a system like MERS to see, okay, we originated that loan 3 years ago. Is it in fact still a current loan? Well, I can check it on MERS and see. I could go to, some of the agencies like Fannie and Freddie and see if it's still current. Because if it comes down to, hey, that loan has, closed and it ended up, refied with someone else, then they wouldn't consider you that current loan originator. So those are the points that are still being navigated, as Jack said. We're working through those and we'll continue to keep you apprised as we get more information. But what we've really found is, what you're seeing exactly on the slide, people that are really starting to win with this program is when they're using just compliant versions of this information. So from there, Jack, we can move to the next slide.
All right, so let's talk a little bit about what we're calling the emerging trigger opportunity. And we have been serving clients for many, many years. And specifically, banks and credit unions have been very, very conservative in monitoring programs, right? There's compliance issues. If you're using credit data, there's a firm offer of credit that needs to be extended to the consumer if they've triggered and you're going after it with allowable use case. So we, over the years, have had some challenges with banks that don't want to monitor or didn't believe in. They thought it was big brotherish, or it didn't align with their value systems. Same thing with credit unions, right? They're very, very astute at communicating with their members. They do everything for their members. They serve members in their communities outside of the credit union itself. And so what's happening now is with HR 2808, it's sort of like spotlighting the allowable use cases, and it's actually highlighting that banks and credit unions actually can use it. So over the last 3-4 months, and even leading up to the legislation, because it was initially signed back in the fall, if you guys remember, we had 6 months till it actually went live. So there's been quite a bit of traction with banks and CUs that normally don't want to talk about it. Well, that's sort of like a new opportunity for us, and just in general in the marketplace, even for the banks and CUs, because now their compliance officers are saying, "Wow, the legislation calls out that we can do this," whereas previously, again, kind of was considered a bad practice. It was predatory. There was a lot of trigger abuse. It came with like really bad energy, and both for the consumer, right? They're being pummeled with phone calls. For the lender, they're losing their inventory to another lender or a bank. So it just didn't have a whole lot of, great momentum. So it was easy to see why banks and CUs didn't want to use the solution. But the market's totally changing. And now we have a lot of credit unions in particular who've worked really hard over the years to communicate with their members. They have robust CRM systems. They're communicating with their members around everything, every holiday, every birthday, every community event, whatever products that they may be offering. There's a lot of traction that they have with their normal communication. So if one of their members triggers with another, for a loan with another lender, they have the operational infrastructure. And we'll talk about that in just a moment. But what we see really changing is new opportunity for FIs where they just simply wouldn't even entertain it. So that may be some of you on the phone here, and just know that there are solutions out there for retention that are absolutely allowable, and we're encouraged by that, and we're happy to support our clients with it where they feel it's a good fit.
That's true. And I think one of the other things that has really made this heat up all that much more is the fact that those consumers aren't being pummeled by a ton of phone calls. They're only hearing from institutions that they did have a relationship with. So instead of getting 50 phone calls, you might get 4 or 5. And that's just really increased the value of monitoring overall. The chance for engagement with my consumer has increased that much more. And what Jack and I have seen is when a client is using this solution of tri-bureau monitoring like what Zactus offers, once that program has been soaked within their loan officer's department and people are used to it, really working it successfully, we've seen pull-through rates of 20 to 25% of all the leads that we deliver from the solution coming through as a new loan. So really the increase on that, I think, is even going to go higher because those stats that I'm quoting of 20 to 25% were back when it was still before the trigger HR 2808 legislation took place. So now that those phone calls are, more limited as far the consumers getting, there's going to be even stronger pull through. We're really pleased about that.
All
Go
right.
ahead, Jack.
Let's move to the next slide here. We just wanted to call out a couple of our data solutions, highlighted, solutions that we serve our clients with today. But what we're really talking about here is our Portfolio Monitoring X solution, which is a solution that allows an end user to monitor the behavior of their consumers for mortgage inquiries. So again, if you have allowable use case, if you have originated the loan, if you service the loan or have a relationship with a third party, theoretically, you can use Portfolio Monitoring X to monitor your consumer's behavior. And just real quickly on how that solution works, we take in your portfolio, we put it onto a program. The bureaus load, all three bureaus load their daily triggers every 24 hours. And then we pass those daily triggers back to our end users. And then they go after their existing customer who's shopping someplace else. So just really just wanted to call this slide out to demonstrate that solution is there. It's intact. We've stood up dozens and if not hundreds of these programs. The retention is extremely high. But it also has to do with, it's actionable data and it's data that needs to be, it's compliant data too, right? You have to follow certain compliance measures with the data, but it's high, it's like rocket fuel for your lead sources. So the other piece of it that's really important is your operational readiness for it. And I think we're going to talk about that in the next slide. So I'm just going to go ahead and jump to the next slide because quite
Yeah.
often we have a lot of interest in the solution, but it's important to understand once you get the data, what you do with it. So Jane, talk a little bit about how we position.
Yeah. Right. Well, and one thing I want to point out is we are talking about this as a tri-bureau solution. There are other vendors out there that do this as a single bureau. When you do that, you're missing a good 50% of the leads that could be coming your way. Monitoring all three bureaus ensures that you're going to see everything, even when a competitor is pulling just a single bureau credit report to start their process. A lot of places would do that, pull a single bureau and wait till the very end to hit that tri-bureau because they knew that would generate more activity out there in terms of those trigger leads being sold. But monitoring all three is a real differentiator. And in fact, one thing Zactus can do is run a complimentary 30-day look back. What we do then is take your input file of the consumer names and addresses, run that against all three bureaus, and we'll return to you the count of how many trigger leads you would have received over the last 30 days based on that input file. And we'll give you those counts and we can break those down by bureau so you can see the difference of lift that you get by monitoring all three. But anytime we talk about that solution with a prospect, we're really trying to understand how does this really fit into their organization? What sort of setup do they have to do the required firm offer follow-up? You are required to do a firm offer of credit on each of these leads that are sent to you. And what's the best way to do that? We really find that, clients that have a strong, telemarketing presence, they're going to go ahead and go through the firm offer um, telemarketing script with their loan officers and make sure that they're getting those leads first thing in the morning, sending them out to their team and having them follow up by phone. And then we also recommend a follow-up email. Those are really the best way to get that offer out to their consumers and get some action happening from that. We also find that we can do any sort of integration with a CRM system and things like that. We'll work all that in, but we just really like to get a good feel for how is this actually going to roll out with your team? How are you going to utilize the information? We can send you data all day long, but unless there's a strong action plan of how that's going to be digested internally and utilized, that's where the success really lies. That's another thing. Jack and I will do training classes for our clients when we kick off a program like this, just to make sure that the loan officers truly understand where this data is coming from, what's required as far as proper languaging when they're on a phone call with a consumer, what has to be set in the any sort of follow-up piece of an email. As we're very strong about compliance, and we make sure that everything is covered by FCRA guidelines as far as what has to be out there as a firm offer, and helping them know best times of day to call, how to handle some of the typical objections they may get, things like that. That type of coaching, I think, really helps get the program over the line. And usually within 2, 3 months, they've really got it down. It's really working well. And they're chomping at the bit every morning when those leads are first sent out to make sure that they can jump on those and start pulling that information through. But we always try and set the proper expectations. That's part of what that 30-day look back is about. We want you to know what you can expect to receive in terms of lead delivery. Most of our clients, in the past, we were seeing about a 1% hit rate each month against their database as far as new trigger activity. Right now, gosh, it's almost down to 0.5%, rates being what they are. It's tough out there. But that's what makes this program just that much more valuable. If you've got a consumer that you've got a relationship with, it makes sense to stay in touch with them, reach out to them anytime there's a new lending opportunity that you can follow up with. In terms of just some feedback, I had a client that I launched just 2 weeks ago. They it took quite a while to get through the compliance process with them. It was a credit union where we had to make sure everything was flowing properly through their compliance department and all that. But once we got them up and running, I did a training class with their team. They really went through all their questions as far as how do I present this to my client. Sure enough, within the first week, on one of the trigger leads we sent over, they already had a loan application in, and they've had more since then. It's really proof in the pudding there. They really feel it's rolling out very great for them, and they're going to stick with it. Um, so that's really the key thing, making sure it fits into your operation and finding what works for you.
Yeah, and when as we talk to our clients, it feels now when they look back on it, they almost are considering it like a bolt on. Like we, how did we do without this, right? Because especially when you think about how much effort it takes to bring a consumer into your brand, and the thousands of dollars per consumer to bring them into your brand, the last thing you want is Rocket or a national going after your loan. And that's kind of what's happening. If you look at the lending hierarchy out there, these top lenders, they are going after everybody and very aggressively, might I add. That's what's making them, but that's why they're the top lenders, because they have marketing and branding and positioning in the marketplace to do just that. So um, what we're seeing now, though, is the mid tiers are understanding the power of the data, and they're bolting it on into their business, knowing that the attrition will be minimized and they will actually retain these loans on their books. And it's, by the way, a refreshing experience for the consumer, who many times doesn't even know that their primary financial institution had a loan program for them. So the experience is changing because of HR 2808, and I think it's benefiting so many people all in one shot, right? The consumer is now having a better experience. The primary financial institution has a better shot at winning and retaining the business. It's creating competition in that only the people that have the relationships can go after these people, but it's eliminated everybody else. The bureaus basically said we no longer sell prospect triggers. It's just we don't sell them anymore, and it's so that's why we're starting to hear the calls are piping down a little bit, and what's happening is the market's like level setting a little bit. So we encourage the conversation with everybody on the call. And again, we do thank you all for joining today. It's our pleasure to talk about this, but really understand that this HR 2808 legislation has changed the marketplace substantially, we feel, and we're here to support those retention efforts for you. So please, if you have any questions or comments, now's a good time. Jane?
Jack, there's one question that just
Yeah.
came in from Melanie, and she was saying, how firm does the firm offer of credit have to be? Just wondering how we can commit to doing a mortgage loan based on only a credit score. That's a great question. These are, preliminary offers of credit. And it is based on just some key credit information. When we first set up a monitoring program, one of the questions we'll ask will be, what's your FICO score threshold? If you can't make a loan to someone who has a FICO score below 620, for instance, we can build that into your program so we won't send you any trigger leads of someone who has a credit score below that. But again, this is based, the firm offer itself. We send templates to our client of what that has to look like, the language that has to be in there for the FCRA. And it will say in there that, this is based off of your initial credit report. If this information has changed, this offer is now null and void. And you can always put additional firm offer requirements within your offering. You can say, this is subject to full appraisal. This is subject to full income verification, other caveats like that. So I hope that answers the question. It is that preliminary firm offer of credit that you're giving them. And then when they respond, that's when you can dig in deeper and find any particular items like, letting them know they have to get pull appraisal, things like that to continue. Melanie, it looks like you're about to let us know time is wrapping up. So,
All right. You're doing great.
uh, very
Any
good.
additional questions out there?
No, I think you've answered everything really great.
Very good.
Is there
Well,
any
do know
last
that
parting words that you guys want to share?
I was just going to say we are, again, keeping our ear close to the ground on this subject as we get more information from the bureaus. We're putting that out there. In fact, Zactus has a blog where we've been posting additional information. I'd encourage you, if you're not following Zactus on LinkedIn, make sure you do, and you can be privy to any additional information that we get as this goes on.
All right,
Thank
fantastic.
you.
Well, you heard Jane. Go follow them on LinkedIn. Zactus is doing so great. That was the preferred partner, keeping our lender members informed on what to be on the lookout for. I thank everybody today for their time. We appreciate it. And you guys take care, and we'll see you on the next webinar. Thanks so much.
Thanks, everybody.
Thank you.